So we're going to start off today with the review of bad debt expense and the comparison between the direct write-off and the allowance methods, and also the comparison of the net income between the two. So we're going to journalize under the direct write-off method and then journalize under the allowance method, assuming that the allowance account had a beginning balance of 89,000. And they use the analysis of receivables method, and then how much higher or lower would the net income have been under each of these methods. And they have each of these, they wrote off the following accounts as uncollectible during the year, and they have the list of the customers in each of the amounts. And then we have our aging schedule as well. So under the direct method, our approach to write off each of these amounts is all four accounts. We just directly credit accounts receivable subledger for each of those, and then debit bad debt expense for the total of 103,000. And then at the end of the year, there's no entry. So our bad debt expense for the year is 103,000, and that's what impacts our income statement. And under the allowance method, right, we had our beginning accounts receivable balance. Our beginning allowance for doubtful accounts was 89,000 at the beginning of the year. And then we had 103,100. That's our debit to allowance for doubtful accounts because that was our write-off during the year. And then at the end of the year, we determine our percentage of uncollectible accounts. We multiply 735 by 1%, 290 by 2%, 111 by 15%, and 70,000 by 30%, and then 94,000 times 60%, and we get our desired ending accounts receivable of 107,200. And then we have to plug our entry for bad debt expense is a credit to allowance for doubtful accounts of 121,300. And so that's going to be our bad debt expense for the year. And so, during the year, we have our journal entry to write off the accounts. We have our bad debt expense entry. And then under the allowance method, our expense is around $18,000 higher in the current year. And so this is more detail on how do we get our desired balance. We have to multiply each of these out on the schedule. And then our unadjusted balance was 14,100, which is 89,000 minus 103,000 would be a debit of 14,000. And then let's see next. Our net income would have been 18,200 lower under the allowance method because our expense is higher. So do you guys have any questions on the allowance method before we go forward? Great. So now we're going to go over some notes receivable questions. And this is generally a written agreement, and it specifies the interest, the term of the loan, and there's a stronger legal claim for it. And sometimes it's, a payment plan for a note for an accounts receivable that they know that they can't get from the customer right away. And sometimes it's, planned out like purchasing something on a 12, pay over 12 months or something like that. And I did just post a homework video for notes receivable this morning. So when you're doing the homework, you can take a look at that. But we'll go over some examples as well in class today. But the maker of the note is the party making the promise to pay. The payee is who the note's payable to. The face amount is the original amount of the note, which is also the amount for which is written on the face of the note, which is usually the amount that the interest is calculated based on as well. And the issuance date is the date the note is issued. The due date is the maturity date, which is the date that the note has to be paid. The term is the amount of time between the issuance and the payment and the due date. And then the interest rate is the interest that must be paid on the face amount for the term of the note, usually expressed as an annual interest rate. So the face amount of this note here is $2,000. The issuance date is March 16th. And we have our interest rate at 10%, and it's due June 14th. So then the term of the note is the 90 days between March 16th and June 14th. And the payee is Perlin Company, and then the maker of the note is Sleeg Company. And so right, to calculate how many days the note is, we have 31 days in March. And so 31 minus 16 is 15. So we have 15 days here. And then June 14th is 14 days in June. And then we have 30 days in April, 31 days in May. And so that's important for calculating how much interest is accrued. Because when we have our interest on the note, the interest rate on the note is 10%. 10% of $2,000 is $200, but they're not actually going to get $200 in interest on this note because it's only outstanding for 90 days. And, it'll say how many days of the year to use, but to simplify in this problem, we're using 360 days is the amount per year that will be used. And so 90 divided by 360 is only a quarter of the year. So we only collect $50 on this note over the term of the note. So in practice, banks and mortgage companies use the exact number, which is 365, but it'll say in the problem how many days a year of interest is used, or if there is a note that's created. A lot of times it will say, it'll clarify how much interest is being calculated. So to record the initial creation of the note, assume that a company accepts a 30-day 12% note dated November 21st in settlement of the account with W.A. Bruin Company, which is past due and has a balance of $6,000. To create this note receivable is an asset, right? So we have to debit our asset for $6,000, and then the credit is the accounts receivable, the overdue accounts receivable that we had with this company. We have to reduce that because we're converting it into the note. And a big reason why a company would want a notes receivable instead of an accounts receivable is because they can charge interest on it. You can't charge interest on a customer's bill unless they've agreed in the terms somewhere to allow you to charge interest on it. So they have a 30-day note, 12%. And then when the note is paid, we have to calculate how much interest is going to get paid on the note, which is 12% for 30 days. So 6,000 times 12% is 720. And then you divide by 360 is $2 per day in interest. And then you multiply that by the 30 days, and we get $60 in interest revenue. And so that's going to be a credit in our journal entry when they pay it back. So we have our initial note of 6,000 as our credit. Our interest revenue is our credit. And then our debit is the total amount of cash that the customer pays, which is $6,060. And then if they fail to make the payments, it becomes a dishonored notes receivable. And then the amount in that case, instead of cash, it would be accounts receivable because they now owe us for the amount of the note plus the interest revenue, but it's currently due. So in the case that they dishonor the note, our debit would just be back to accounts receivable, but now they owe us $60 more, right? But because a notes receivable is an agreement to be paid in the future on a specific date, accounts receivable is much more casual, right? They get the bill, it's on the invoice. There's a due date on the invoice, but it's more just this is due now-ish, and we would like to get our payment sort of as soon as possible on an accounts receivable. On a notes receivable, there's interest, there's a due date. They need to pay it by a particular day. And then when they don't pay it, it goes back into accounts receivable because it's due right now. Like it's already overdue. So at the end, we have to record an adjusting entry at the end of the period for any interest that's accrued during the period. So, for example, they issued a $4,000 note, 90 days, 12%, dated December 1st to settle an accounts receivable. And the accounting period ends on December 31st, but the note isn't due until it'd be another 59 days after the new year. So what we have to do is accrue the interest that's recorded so far so that our revenue is accurate. And so we have to use $4,000 times 12%, which would be 360, divided by 360 because we're using 360 days in a year. Or okay, 4,000 times 12% is actually 480. Divided by 360 is 1 1/3 times 31 days in December is actually $41.33, but they have it as $40, but it's oh, they multiply it by 30 instead of 31 days. So that's how they calculated it in this instance. And so we would, at the end of the year, our adjusting entry, we debit interest receivable, and then we credit interest revenue. And then when the note is paid in the following year, we record the rest of the interest revenue for the next 60 days of the loan. And then we credit the cash of the total amount paid, right? So that's the full 90 days of interest plus the initial face amount. And then we credit our notes receivable, our interest receivable, and then the interest revenue for the year that we're in now, which is for March 1st of the following year, right? So that way we follow our matching principle. Interest is accrued over time, and we need to have that revenue in the period in which it's accrued. So let's have some practice just calculating interest here. So Anderson Paper Mills signs a 120-day note for $8,000 with the local bank at 9% interest. How much are they going to have to pay on the note? And then, does anybody have the answer? Yep, exactly. Perfect. So yeah, after 120 days, right? So we have to take our initial $8,000 times 9%, and then that's the annual interest, and then we have to divide it out for the 120 days out of the 360-day year, and we get our $240 in interest. And now we're going to do some determining of the due dates on these notes. So we have January 5th. The term of the note is 120 days. And also we'll determine the due date and the interest due at maturity. And this is exactly like the homework video that I posted this morning that has one exactly like this. So for the January 5th note, the term is 120 days, and so it's due on May 5th because we have 31 days in January minus 5 is 26. And then we have 28, 31, 30 from April. And then May is 31, but there's only 5 days left in May. And then that would be, right, the distribution of our days. So that's how you guys have to think about that when determining how many days until it's due and how many days have passed until like the end of the period. For example, if it had like a March 31st year end or quarter end, they would have to accrue the interest as of that date, right? Not for this example. Well, yeah, for this example, right? If they had to have quarterly reporting, they would have to accrue the interest for this period to report on their quarterly financials. And then when the note finally matures, they'd have to record that extra 35 days. And then at 6%, the interest is $2,000 because they had $6,000 for the full year, and then it's a third of the year. So for February 15th, the due date would be March 17th, and the interest would be $100. For May 19th, 45 days later is July 3rd, and the interest would be $620. And for August 20th, 90 days later is November 18th. And the face amount is 42,400. We got to multiply by 5% and then divide by 360 times 90. And then for the October 19th note, then the due date is January 17th. And so then that would also be in the following year, right? So then we'd have to record our interest as of December 31st. So journalize the following transactions in the account of Missouri Gaming Company, which operates a riverboat casino. So initially we have received a note, $30,000 for 60 days, 5%, dated March 29th, from Carey Plant on account. So the on account here indicates that it did come from an accounts receivable. And so we're going to debit our notes receivable and credit our accounts receivable. We can think of this as a Missouri gaming company, which is, right, like this person was gambling at the casino and they ran up a bill and now they got to pay it back with interest. And then we received another note from John Kelly on account, so we have to debit our notes receivable and credit our accounts receivable. And on May 28th, the note from Carey Plant is dishonored and the customer's account is charged for the note, including the interest. If we recall back to the note, it was 5% for 60 days, which comes out to $250 in interest. So we record our interest revenue as a credit, and then we debit accounts receivable for the full initial amount of the loan plus the interest. And then for John Kelly also dishonors the note. So we have to do the same. So we take 24,000 times 8%, divided by 360 times 60, and then we get our interest of 320 plus 24,000. And then on August 26th, we receive cash for the amount due on the dishonored note dated March 29th, plus interest for 90 days at 8%. Which we charged on so this company was able to charge 8%. They initially charged her 5% when she had a payment plan. She refused to pay it on May 28th for $30,250. And then after that, interest started accruing again at 8%. And then August 26th, 90 days later, they give it to us that it's just 90 days. And then they charge another $605 in interest. So we have to credit interest revenue for the same amount, and then the cash is the total amount that we receive from the customer. And notice how the initial $250 in interest, that was recorded back in May. So we don't record that again here. That was included in this accounts receivable, and then this interest revenue is new interest revenue after the note was dishonored, but then now they're paying it and they paid a little bit more. And then wrote off against the allowance the amount charged to John Kelly. So we debit our allowance for doubtful accounts and then credit our accounts receivable to write off this account because John's not paying it. And so now we're going to go over some of the reporting receivables on the balance sheet. So accounts receivable is a current asset, and all receivables expected to be collected within a year are recorded on the current assets section of the balance sheet. If we had a note receivable that was longer than a year, we'd record whatever principal payments are expected to be collected within a year. We can't, so if you think about a mortgage and some of the payment every month is principal and some of it is interest, every month the bank is recording the portion that's interest as revenue, and the portion that's a principal payment is just a credit to the notes receivable because that's the principal amount, right? So if we're reporting on the balance sheet notes receivable, and part of the payments that we are expecting to receive in the next 12 months is interest, some of it's principal, only the principal payments would be in the current assets section. The interest wouldn't be there because we only record interest revenue after the time passes. And so it wouldn't be an interest receivable. It wouldn't be an asset on our balance sheet until we accrue it. So we can't count that into the future. But for accounts receivable, it's pretty simple. They're going to be collected within a year. So we report that on the balance sheet. And then we also in the notes, this is from Under Armour. The company we report our method for determining the allowance for doubtful accounts. So they make ongoing estimates regarding the collectability of accounts receivable and maintain an allowance for the estimated losses. As of December 31st, the allowance for doubtful accounts was about $7 million for Under Armour. And a company may choose to subtract the allowance for doubtful accounts from accounts receivable to report only the net amount. For example, on Under Armour's balance sheet here, it just says accounts receivable net. They're not reporting it separately. If it's substantial, they can choose to report it separately, and they just report accounts receivable, allowance for doubtful accounts, and then probably have a subtotal for the net amount of accounts receivable. And in the notes, they'll also report, unusual credit risks, or if it's something that really, if it's just something that investors care about or should know about, it's going to be reported in the notes to the financial statements. And so one example of this that I was able to find was a firm. You guys are probably all familiar with the buy now, pay later. You go at Walmart, it's on like every single sign looking at TVs. You can pay 4 months of installments and no interest or whatever. And then afterwards, that's when the interest would start and fees and stuff starts to accrue. Very predatory, really not a good idea to affirm things, but I hate that that's a verb now too. I'm gonna affirm it. Yeah, they really good on the marketing there. But right, a firm's whole business is making these short-term loans so people can buy things. And so the credit worthiness and the allowance for credit losses for a firm is super important to investors. And so they went and in their notes to their financial statements, they report the whole aging schedule of their receivables. And so their non-delinquent loans come out to, so it looks like about 6.6 billion. Because these numbers are all in thousands. So it's about 6.6 billion in non-delinquent loans. And then as soon as someone stops making their payments, that's when the timer starts on the 4 to 29 calendar days past due. And then we have all these different amounts here. And the the little footnote here says that 47 million of the loans are 90 days or more past due, but are on non-accrual status. This means that they've made that entry for dishonoring the notes receivable, and they can no longer charge interest because the term has passed, and for whatever state regulations are preventing them from charging that predatory interest after the term of the loan. Right now, it's just sort of back into that non-accrual state. They can't accrue interest anymore. They just got to send it to collections and get what they can get, right? So, and then they also had, they have their allowance. So they have their total receivables. Looks like it's at about 7 billion. And then at the end of the period, their provision for credit losses was about 400 million. Which I'm just trying to see what percentage that is. About 6% allowance. So at the beginning of the period, they had about 300 million, and then they charged off 600 million in credit losses, or their provision this year was 600 million. That was their bad debt expense. And then the charge-offs, what they actually wrote off, was 552. And then they recovered from previously charged off 51,280, and then had 396 was their balance at the end of the period. And so, I don't know, it's interesting to see how companies are actually thinking about this, I think. So this is, I mean, the reason that they're so transparent about this is because that's their whole business. Normal businesses, they're not required to report all these disclosures because, Under Armour is a multi-billion-dollar business, and we saw their allowance for credit losses was 7 million. We're a firm, that's their whole business, and the receivables is probably a large section of their balance sheet, and their provision for credit losses every year is $600 million. And whether or not they're going to be profitable in a given year highly depends on how much people are paying them back or not. So accounts receivable turnover is an efficiency ratio for how many times per year is the accounts receivable being collected. And so we take our sales, divide it by the average accounts receivable. And so we get our average accounts receivable by adding up the two beginning and ending, dividing by 2, same as the other turnover metrics. And then we get, so for Under Armour, we can get our turnover metrics by taking 527 plus 569 divided by 2, and then we divide our total sales by that number, we get 10.4. And so higher number is generally better. It means that they're collecting their receivables faster. And collecting receivables slower can actually be sort of a red flag. And that really plays into the days in accounts receivable metric too, because if we take our daily so if we take our average accounts receivable divided by our average daily sales, we determine our average daily sales by dividing sales by 365. We can get our average days in accounts receivable, and it goes from 50 days to 35 days. That's the aging of right, we were just looking at calculating our allowance for doubtful accounts based on how old the accounts receivable are. If the average age of our accounts receivable that goes from, right, this is more as like during the year, how long did it take on average to get collected? How long did our receivables take? If something goes from 50 to 35 days, that's a huge improvement. But if it goes the other way around, if generally it's like 35, 35, 35 every year, and then one year it's 50 days, that's a huge red flag for a business because something really weird, like there better be an explanation. Something really weird is going on. Like the customers are not able to pay for some reason. It calls into question how much higher should their allowance for doubtful accounts be this year because, right, on our aging schedule, stuff that's higher, a higher amount of like aged accounts receivable, it's less likely to get collected. And it also means it's like, are they having to be this generous with their customers to get them to buy more? Do they have to extend more credit? So, and it also, we talked about lapping last week with the cash internal controls. That's when someone is applying this period's, right? It's like you picture an accounts receivable clerk and they receive a check for an accounts receivable and they just take it and they sort of take the money from that. And then the next time a check comes, they apply it to accounts receivable number 1 that was due first. And then the next time a check comes in, they apply accounts receivable 3's check to accounts receivable 2. All that does is push back accounts receivable. It pushes every single receivable invoice back one. And that would increase the accounts receivable at the end of the period and make it unusually large for the amount of sales that were made in the final month. And that would increase our days in accounts receivable. So it could be when accounts receivable is suddenly and unreasonably more aged than normal, it's a bad sign for the health of the customers, the health of the business, and can be an indicator of fraud. But a reasonable explanation could be, oh, we had a lot of sales in the final period, like a whole bunch of sales in December, and it's all outstanding due until January, where we didn't last year. And so that's why it's different, right? So there could be explanations for why the change is different. And they're also inversely related to each other. So accounts receivable turnover 7.2 would mean that the accounts receivable turned over 7.2 times during the year. And also if we take 365 divided by 7.2, then we get our 50 days in accounts receivable. And then when accounts receivable, when the turnover ratio goes up, the days go down because it turned over more times during the year. So. And then since we have a little bit of extra time in this chapter, I just want to go over this fun thing called earnings management. And it basically is fraud, but it is a way to manipulate that sometimes businesses use to manipulate their earnings. It's the intentional adjustment of these accounting estimates or timing of transactions to achieve a desired financial result. And they'll shift these accruals like bad debt expense, like the coupon payable expense that we went over in previous chapter, the sales returns estimates, and shift revenues from one quarter to another in order to smooth income. And so how this generally goes, it's in a cycle. Usually in a quarter, for example, they're estimating that this company is going to have 72 cents in earnings per share this quarter, and earnings comes out at 70 cents. And it's a high pressure situation, and the CFO goes to the controller and is like, these numbers can't be right. Can't be right. It's not possible. We made 72 cents this quarter. I know we did. You have to find out how we made 72 cents this quarter. And so they'll go back and they'll adjust something like the allowance for doubtful accounts or the estimates around returns or warranties or other sorts of reserves to make a mostly inconsequential adjustment that bumps it up 2 cents. And so instead of an earnings miss, it's earnings were exactly on point. And then next quarter, when it's 75 cents and they were expecting 73 cents, then they just sort of reverse it back into the amount. And a lot of times, if it's between quarters and it's not at the end of the year, there's much less auditor scrutiny. And it can get by, and it can just smooth income like that. And then, like, this is something that's actually happened. We'll go over the Dell example in a bit. But I do want to preface this with integrity in the accounting profession is so, so important. Like, if you're ever in an environment where you're being asked to do something like that, like, please just remember that that's not normal. That's not the way things should be. And honestly, start looking for another job. Like, it doesn't end well for companies that do this. So a lot of times it'll be, they want to meet earnings targets, they want to qualify for bonuses, maintain stable and predictable earnings trends, right? Because a stable business is generally valued higher because it's seen as less risky, right? And then influence perceptions before financing or merger activity. If it's like a really important quarter and they want to influence it, then they could. And so, bad debt expense and allowance for doubtful accounts is probably one of the easiest and most subjective ways that companies will do this. And then sometimes something will occur called the big bath. And that is, say there's an example like 2020 and 2021, or 2020 and 2022. 2021 was a pretty big year for corporate profits. But 2020 and 2022, everything was terrible. Companies were expected to perform poorly. And missing an earnings on those years is really not a big deal. No one's getting their bonus anyway, right? And so they'll take what's called the big bath and they'll wipe away all the previous little adjustments that they made, and earnings will decrease even more than they should have. And then in the recovery year, they can show an even stronger recovery. So an example of this actually happening was Dell. They finally got fined in 2010, but I think it happened around 2006. And they created a lot of really large accruals for restructuring, taxes, bonuses, and other reserves. And the actual expenses were much lower than the amounts reserved. So they had a really bad year. And they laid off a bunch of people. And they recorded these huge restructuring charges and tax charges and bonus charges. And instead of when the next year came and the time to use up these accruals came, they just didn't use it all up, and they left it in what they referred to as a cookie jar. And then when they were missing earnings, they would dip into the cookie jar and take out these reserves, which are fake, honestly, just fraudulent reserves. They weren't real, right? And so eventually they were found out when things inevitably go wrong, and the SEC charged Dell and some of their executives and employees, and Dell had to pay $100 million in penalties. Executive paid additional fines. Michael Dell, the founder of Dell, had to pay $6 million personally for this fines. So yeah, this became like the number one example of cookie jar accounting and earnings management. And so, does anyone have any questions about this? I mean, it's yeah. So I this was something that my auditing professor at Hamlin taught in class, and well, I haven't seen this happen as I've been an auditor. I guess I'll just ask the questions, how would I know? How would I know? Because if it's a quarterly review and we're not going full in on the auditing procedures, how would we know that something's been shifted from Q1 to Q2? Pretty confident that things are accurate at the end of the year in Q4, right? But if things are happening mid-year, it's how would you know? So, um, yeah, that's all I have for chapter 8. So thanks everyone. I'll stay afterwards if you guys want to talk about questions on a homework or anything like that.